that's right. I mean, I think the market wants kind of a cessation of hostilities and no re-escalation. But interestingly, if you see the market sensitivity yesterday to these headlines about the visa restrictions, and therefore it seemed to have people say, well, then there's no makings of any agreement here. You took, about 250 points off the Dow in an hour after you'd had an intraday recovery. So it's almost like today, guess what? It feels good because we're not bashing our head against the wall again.
Although,
that's the reason it's a positive.
I read these reports and I thought, okay, this doesn't sound any more promising to me.
No, and I also don't think it's the only thing going on. I mean, I know it's the only thing that we can identify on a timely manner that the headlines are moving the markets for the most part. But, for 4 years, the stock market has gotten up to this particular level of valuation between 16 and 17 times forward earnings. Pretty much it kind of gets and sits there and goes sideways and waits for the next reason to go in a different direction. And right now we have very low interest rates. Right now Powell's speech, I think, was well received in the sense he's going to be accommodative. But in the absence of obvious traction in the economy, it's going to give you a convincing sense that we're just coming out of this soft patch. This is where we are.
Erik, what do you do at a time like this when there's so many potential pitfalls?
Yeah, so we are, unlike earlier in this year when we were very risk on and we've been trimming that back through the year, we've actually now gone to a lower risk posture. We've gone underweight global equities, underweight global government bonds, really reducing risk, not because we think the economy is going off a cliff. We actually think the risk of recession in the U.S. before the end of 2020 is still quite low. It's just that we don't see a catalyst for upside from here. Earnings expectations are quite modest, actually negative in the short term, 10% growth next year. We don't have clarity on where that comes from. Meanwhile, at full valuations, we're not going to say rich, but full valuations. Meanwhile, there are all these risks stalking the globe. And so what we expect in the short term is lots of volatility, not a lot of upside, more risk to the downside. So we just want to take beta down. We want to be cautious.
Which means what? If you're underweight in global stocks and in government bonds, you're overweight in cash?
We're overweight cash. First time in this expansion, I can say we're actually overweight cash. We're overweight credit relative to government bonds, and we're corporate bonds. And we're biased towards the U.S. relative to the rest of the world. We think we're entering a period of two-tier growth, or we're in a period of two-tier growth where the U.S. is experiencing a soft landing, growth stabilizing around 2%, supportive overall economic conditions, the consumer's fine. And you're seeing the growth slowdown continue in Europe and Japan, which are much more sensitive to global trade. So we want to be biased towards the U.S. equities. We're actually neutral U.S. large cap, overweight small cap, where we see some good values. Okay. And overweight U.S. credit, where we think being paid carry from good quality contractual income at this point relative to very low global government bond yields is pretty attractive.
Charles, how about you? What's your take on the markets right now?
Market participants are rational in the sense that they are sensitive to what's going on the China trade front. Between the U.S. and China, the two countries account for over 45% of incremental global GDP in an $85 trillion global economy. So markets are very sensitive to what happens on the trade front. Against that backdrop, we've had manufacturing slow down in China, India, the Eurozone, United States, spillover effects that we see in PMIs to service economies in each of those countries. Central banks have responded by turning dovishly. The question is, will the U.S. Fed be behind the curve? Some say they are. Some say they're catching up. In March, they indicated they would revisit the balance sheet normalization. Powell indicated that in his speech yesterday. Inflation's not a problem. 17 trillion of negative yielding debt. It's clear that those countries with negative yielding debt, from Sweden to Japan, don't have outsized GDPs.
There's a new one. I was just reading it.
Greece.
Sorry, go ahead. Greece.
Amazing, isn't it?
Greece had an auction of 3-month bills, minus 0.02.
A $200 billion economy with Greece. A couple of years ago, we thought Greece implodes, it's going to be cataclysmic for the rest of the world. Now,
it's crazy. Now you're paying Greece to hold your money.
Isn't that amazing? Now, in the United Kingdom,
here, you're a better banker.
Nearly a $3 trillion economy, fifth largest in the world. That's not simply a national issue, Brexit. So that could actually, because economies globally are slowing, that could be a pushing point into recession.
That's scary stuff, but are you suggesting people hide, or are you suggesting that they're somewhere?
I'm suggesting that they take a more defensive position than they might otherwise take. The economy obviously is in record expansion, length, duration of its expansion. We're expecting Q3 earnings down about 4%. The bar has been lowered. Most likely people will exceed, but it's going to be the guide. And the guide will depend to a large degree on what happens on the trade front.
But here's where I talk myself back in circles about this.
Yeah.
Okay, economies are weak, but you've also got all of this negative yield out there, which makes me think that stock prices could get pushed higher and should deserve a higher.
Do you think companies make a CapEx decision in the United States, either here or abroad, based on whether Fed funds are at 187
No.
or 125?
No.
Doesn't matter. What it does do is it impacts investor and business confidence, which is negatively impacted by the uncertainty caused by the trade problem.